crypto is a narrative-driven space, okay? Because it really runs on trust. Right. And so we know Bitcoin, the thesis is trust and, digital gold. But I think the story now is programmable money. And so maybe what you're seeing is people are discovering that you not only want programmable money, but you want to be running on the biggest network that does programmable money. And Ethereum is 300 billion. So it is the largest smart contract blockchain. So right. I think that's why Ethereum has the opportunity to really transform. Yeah.
Tom Lee begins by illuminating a core structural truth in financial markets. Institutional investors operate within strict guardrails. When volatility, as measured by the VIX, spikes, they are compelled to de-risk. Market drawdowns and volatility aren't just emotionally jarring, they are mandates for institutions to sell. This is crucial to understanding why sharp drops often lead to what Lee calls waterfall declines. However, history tells us something powerful. Unless those declines spark a recession impulse, the rebounds are almost always V-shaped. Lee anchors this argument in a century of market data. When high-yield credit doesn't react negatively, even during an equity sell-off, it signals the drawdown is driven by a growth scare, not genuine systemic stress. That's precisely what he saw happening during recent market dips. Despite intense fear and selling pressure, the credit markets remained calm. This was the telltale sign of a forthcoming recovery, yet many institutions refused to believe it. Why? Because they were convinced that without the Federal Reserve cutting interest rates or launching a new liquidity program, there could be no recovery. But Lee disputes that narrative outright. He argues that the idea markets only rally when the Fed injects liquidity is an illusion. In fact, much of the Fed's liquidity often stays locked in the banking system, as happened post-2008, rather than flowing freely into the economy or markets. So where was the real liquidity coming from? Retail investors.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
There's a couple of things. Institutional investors, they have to sit in guardrails. And like when the VIX goes up, they have to cut risk. And when the market has a drawdown, they have to cut risk. So basically, when the market falls and there's volatility, institutions can't hold on to much. So they're forced to sell. And so we would show them, the reason we said there's waterfall declines are V-shaped is that if you look at the last 100 years, as long as you don't generate a recession impulse, it's always V-shaped. So that was our bet. It's like, this is a growth scare because high yield wasn't reacting, so it was just the stock market reacting. Now, a second thing that got people super bared up, our institutions, was, Tom, the Fed's not coming to the rescue. They said, the only reason markets rally is the Fed cuts rates and unleashes money. And actually, our argument was, that's actually an illusion. So our belief was that you'd still get V-shaped even if the Fed didn't cut. But a lot of people were saying, look, the Fed said they're not going to cut. So we're going to actually keep falling. But instead we had the V-shaped. When the Fed is adding liquidity, it's just giving the money to the banks. So if the banks aren't lending, like that was happening like after 2008. They gave the money, the banks just built up reserves. Like it wasn't sloshing around. So the more important money is actually retail. And that's there's four cohorts, 4 or 5 real distinct cohorts in the market today. So we know there's institutional, there's non-US, and everyone's like, oh, we're leaving the US. There is high net worth,
family offices.
Yeah, exactly. They stay bearish because they follow what hedge funds do. Then there's corporates who do buybacks. And then there's retail. Retail was the only one buying the market at the April lows.
40 billion in March and April.
Yeah. I'm very proud of the retail investor. I think it's because retail investors see this as a stock market. they're like, I like Palantir. I own Meta. Like, should Meta get killed because of tariffs? You know what I mean? Like, should Palantir get down to 80? Like, if you think about it, like, a retail investor sees it as stocks.
Right.
But the higher up you go, they're more macro. They're like, oh, Trump's going to just drive us off a cliff. You know, Fed's going to kill us. And so these actually create biases.
Right.
And then when the actual economy doesn't, or the stock market doesn't react to what their framework is, then they're like, oh, the market's insane. This is the dumbest rally.
Correct.
Only retail's buying it. So then they're caught off sides because they're now sitting on cash, institutions, on a complete full V-shaped recovery. And that's why it's the most hated V-shaped recovery. So, but if you look at the bond market, it flips. The bond market historically votes Republican.
Correct.
So most people think Trump is a madman, right? Because they didn't vote for him. So it's a partisan stock market. And actually, people... So these have been uncomfortable conversations that we've had all year because...
I would imagine. Yeah.
Yeah, because they're like, Tom, we can't... You're telling us not to sell. Because our advice was, you like, don't sell. Like, even though I didn't know where the bottom was, I did know it would be V-shaped.
Right.
But they're like, Tom, we can't do that. You know? And then I was like, well, I showed the stat. Whenever the VIX is above 60, and then it closes below 30, 100% of the time, it's been the bottom.
Correct.
And they're like, well, it's different because the Fed's not going to save you. So everyone found a reason to actually argue for why a recession was starting. And as you know, economists went full-on recession call.
That's correct.
So if you're a equity guy, how can you go stocks are going to do V-shaped when the economist of the firm just said there's a recession? So I think they got caught, and yeah, we're not having happy conversations with people. It's fact-based because we had a drawdown of more than 20%, and then we made a new high. So like the weird math that like, let's say a commodity trading advisor, a CTA
right,
has is that when you have a drawdown and then you make a new high, that date is the start of a bull market.
Huh.
So actually, like in the mind of the institution now, breaking 61.41 was a new bull market.
Wow.
But the retail investor bought it at 4,800 to 61.41. But the algos are going to say a new bull market started like last week. You know, Ethereum, I'm sure the audience kind of knows Ethereum, but I like Ethereum because it's a programmable smart contract blockchain.
Right.
Okay. But that's a mouthful.
Yeah.
I would say the real reason I kind of would say I backed into Ethereum is that stable coins are really taking off.
Circle, $70 billion company.
Circle's like the best IPO in 5 years.
Correct.
And it trades at 100 times EBITDA. And it has made the performance. For some funds, it has made their year.
Wow.
It's what put people in the top 1%. So proof in the traditional Wall Street world, Circle is like God level stock.
Right.
And it's a stable coin. Stable coins are the ChatGPT of crypto because it's really crossed over into the mainstream. But it's really evidence that Wall Street is trying to equitize tokens.
Correct.
But then the crypto world is tokenizing equities because they tokenized $1, right? And then now you're seeing, JP Morgan wants their own stablecoin, Amazon, Walmart, Goldman. Well, stablecoins are a great business model and they work really well for consumers and merchants, but they all have to operate on a blockchain.
Correct.
And the majority of stablecoin transactions take place on Ethereum. So Ethereum's been like kind of out of favor. You know, it peaked at close to 5,000 several years ago, and it was stuck at like, 1,400, 1,500. It's back to like 2,400. But stablecoins are only 250 billion today.
Correct.
It's 30% of the gas fees on Ethereum. And Ethereum mints more than 50% of all stablecoin creations. Treasury Secretary Scott
he loves them.
Yep. And he says he thinks it's a $2 trillion market, which is 10x increase. The U.S. government wants more stablecoins because stablecoins collectively are the 12th largest holder of treasuries.
Correct.
And they're creating a lot of dollarization. 80% of stablecoin usage is outside the US.
Right.
So, but a 10 times increase in stablecoin creations is a exponential growth in gas fees for Ethereum. So I think Ethereum is a very direct beneficiary of Wall Street trying to equitize crypto.
Correct.
And crypto tokenizing equity. It literally sits in the middle. And so I think that's why Ethereum, I think, is going to be rediscovered this year. And then, of course, we're seeing it now because Robinhood is...
Shifting gears to crypto, Tom Lee dives deep into Ethereum, and not just as a speculative play. Ethereum, he argues, is uniquely positioned at the intersection of two transformative trends: Wall Street's desire to equitize crypto assets and the crypto world's push to tokenize real-world equities. This crossover is being powered by stablecoins. Stablecoins are the ChatGPT of crypto, Lee says. They've crossed into mainstream utility. Circle, for example, has built a $70 billion business and is treated as royalty on Wall Street. Stablecoins are also a massive holder of U.S. treasuries, now the 12th largest in the world. This has geopolitical ramifications. Nearly 80% of stablecoin activity happens outside the U.S., increasing global dollarization. Crucially, most of this activity runs on Ethereum. It handles over 50% of stablecoin issuance and 30% of gas fees. If the stablecoin market grows 10x to $2 trillion, Ethereum gas fees, and thus its economic relevance, will skyrocket. Ethereum is being rediscovered, not just because it's recovering in price from $1,400 lows back toward $2,400, but because it's powering the plumbing of programmable money.
Because I think, crypto is a narrative-driven space, okay? Because it really runs on trust.
Right.
And so we know Bitcoin, the thesis is trust and, digital gold. But I think the story now is programmable money. And so maybe what you're seeing is people are discovering that you not only want programmable money, but you want to be running on the biggest network that does programmable money. And Ethereum is 300 billion. So it is the largest smart contract blockchain. So
right.
I think that's why Ethereum has the opportunity to really transform. Yeah. I won't necessarily speak to BMNR specifically, but I can speak to why treasury companies, which is what BMNR is, makes sense. Because someone's going to say, oh, well, if I want to bet on Ethereum, why don't I just buy the ETF?
Right.
Or why don't I just buy it on chain and
custody or something?
Custody, right? Yeah. But see, a treasury company has 5 real important pieces of optionality. Okay. So if you buy an ETF or if you buy Ethereum on chain, your units held of Ethereum is going to be constant, right? I mean, if you buy an ETF, you have a contractual amount of Ethereum you
Correct.
have. And it maybe shrinks because they charge you fees. But these treasury companies, their goal is to grow the token held per share.
Right.
MicroStrategy, that's their benchmark, key performance metric. So one, if it trades at a premium to NAV, net asset value, they can issue stock and create more net asset value per share.
Right.
That's actually what they call reflexive growth. I don't think there's very few things in the equity world that are reflexive that way. Number 2, because the underlying token is quite volatile. In fact, Ethereum has twice the delivered volatility of Bitcoin.
Correct.
If you held Ethereum ETF, and you said, I want to leverage it and buy more Ethereum ETFs by borrowing money, the bank's going to charge you 10%. But if you're a treasury asset company, 1, you're a corporation, so your cost of money is cheaper. But 2, you can sell the volatility in the form of convertible or derivative, and then your cost of capital in MicroStrategy's case is 0.
Right.
So you got 2 levers to pull. The third lever you're pulling is that you have a market price to NAV, and you have an equity, and then there's other treasury companies outside, price to net asset value.
Correct.
And so if something's trading at NAV, price net asset value, and you're trading at 3 times, you could do mergers and buy other treasury companies. So there's this arb that way. The fourth is you can create an operating company. Hey, let's create a business that helps the DeFi ecosystem.
can lend out ETH, stake ETH. All
Staking, yeah.
Correct.
And that you don't really do in Bitcoin, but actually on Ethereum, that's a huge benefit.
Yeah.
And then the fifth is you have what I call, you create what I call a structural put. Okay. So an example is MicroStrategy has 600,000 Bitcoin.
Yep.
If the US government wants to get to 1 million Bitcoin, or Qatar, or UAE, or I don't know, UK, okay, and they say, I'm going to buy 1 million Bitcoin in the open market, the UK buying 1 million Bitcoin, or the US buying, or China, Bitcoin's going to $1 million, right? Whereas someone says, I can buy like the US government might say, MicroStrategy has 600,000 of this already.
Yeah.
I'll pay 200% premium, and it was cheaper than paying $1 million per Bitcoin. So that's
Right.
called a sovereign put.
Right.
Well, guess what? In the Ethereum world, because it's a staked token, if one of these treasury asset companies gets to 5% of ETH, they are hugely important to the ETH ecosystem.
100%. Yeah.
So then their multiple should go up. Because, Goldman Sachs, for instance, if they do a Goldman dollar and it runs on Ethereum, they want to make sure the Ethereum network is secured. So eventually they're going to be buying a lot of Ethereum.
Right.
But then the staked entity already has it. So maybe they'll just buy the staked entity.
Right.
So the staked entity has a Wall Street put.
Right.
Tom Lee's insights aren't just contrarian. They're data-backed, historically informed, and strategically grounded. In a market driven by fear, noise, and reactionary thinking, Lee continues to be a voice of clarity. From debunking myths about the Fed's omnipotence to championing the overlooked brilliance of retail investors, he challenges narratives that often trap institutional capital in a loop of missed opportunities. And when it comes to Ethereum, Lee paints a future where crypto is no longer a speculative sideshow, but the very infrastructure powering global finance. Stablecoins, tokenized assets, and the programmable economy are not only real, they're growing faster than anyone predicted. In a time when most are too scared to act or too rigid to pivot, Tom Lee reminds us that conviction, patience, and facts are the true edge in investing. Whether you're in equities or crypto, the message is clear. Follow the data, not the crowd. Please like and subscribe.